I was reading a note over the weekend that was talking about how Evergrande is definitely a deflationary impulse in China. Then the flip side, you have these record high power prices all over the world. You have high LNG prices. That's inflationary. And kind of when they go more green, that becomes more inflationary. So these two opposing forces at the same time that then China has to manage.
Yeah, and the energy story I think is interesting because it could be deflationary. It certainly could hit growth quite hard, I think,
yes.
If consumers aren't protected. And I think that's going to be one of the challenges that authorities have got to deal with. The UK is trying to manage that process as we speak. And it's going to, again, joining the dots, it ripples through the food sector. The implications, hard to manage and hard to understand. Bhanu Baweja, UBS's chief strategist, joining us now on the line. Bhanu, let's start with Evergrande. How messy could this get?
I don't think this is a Lehman moment. I think, look, when you try to reintroduce moral hazard after 4 major credit cycles, it is going to be messy. The biggest risk out here is not what happens to the suppliers or what happens to the financial system in the near term. I don't think that's an issue. I think China has managed that reasonably well. The default levels are pretty low in the overall economy, and the capital adequacy for banks, particularly the large banks, is quite high. I think the most important issue is what this does to the collateral of the entire credit boom, which is property prices and therefore confidence in property itself. People have tremendous faith in Chinese policymakers' ability to try and put a floor under the property price and therefore to prop it up. I think as they try now to emphasize the redistribution of the pie as opposed to just the size of the pie, there is a risk that in the next 5 years, the CAGR of property prices is going to be very low, potentially even close to zero. And that comes with not just a slowdown in Chinese growth, but much larger implications, as your previous guest was saying, for things like commodities. So I certainly don't think this is a credit crisis yet, but this is going to be a major slowdown in growth here.
Bhanu, does the market then have it right in how it's interpreting it, if it's going to front run that a little bit?
So, you know, different markets are saying different things. What's really interesting is that if you look at the credit market, especially in the high yield space, of course, there is a reasonable amount of panic out there, not so much in the IG space. But then if you look at the FX, it doesn't want to know, right? Dollar CNY forwards, dollar CNY vol, they would remain extremely well behaved, right? And what's happening in the property market, what's happening in the equity market is not independent of, but precedes what's happening to Evergrande, right? China is tightening both on regulatory fronts and credit fronts, and that's why Chinese economy and Chinese asset markets are going to be under pressure. So I think the market that's most correctly priced here is probably the credit market, and the market I think that's least correctly priced is FX. So in terms of risk reward, this would be a time where we should be considering hedging downside in the renminbi for the medium term.
Just more broadly, you started off this conversation saying something quite interesting. We are reintroducing moral hazard. You said a lot of interesting things about it, but that's what really stood out to me. Thought I'd just cover myself there. You talked about reintroducing moral hazard. Is that what's going to happen here? Because we've got a Fed meeting coming up later on this week. We've got other central banks, 13, Alex tells me, meeting this week. Are they prepared at this stage, given the fact that we've just come out of a pandemic, given the fact that we are dealing with other issues, are they prepared at this point, do you think, to reintroduce moral hazard?
I mean, from the perspective of, if I hear you correctly, if you're thinking about taper and talking about higher rates, I think the Fed already drew that line in Jackson Hole when they said we are moving towards taper, and I think that's what we will hear this week as well. But they will emphasize that we are not going to move towards worrying about rate hikes anytime soon. I don't think that they will say that. Their dots will, however, just high.
What I'm interested in finding out is up until now, there has been this perception within the markets that they will be supported and protected by the monetary authorities. Does that still exist? If this correction gathers pace on the downside, how far is the Fed prepared to go before it feels it needs to take action?
The strike of the Fed's put is quite close. So the Fed remains extremely focused on financial conditions. It has been since Alan Greenspan, and then only become more focused on financial conditions. So if you see credit spreads blowing up, if you see S&P down 15–20%, maybe even less, I think the Fed will step right in. So that put does exist. That's a completely different matter to saying that you're going to see continued liquidity help. Given where real interest rates are, given where credit spreads are, you're not going to see incremental liquidity help. So the ability of liquidity to swell valuations, I think, is done. We are probably at a global minimum for real interest rates. We're probably at a global minimum for credit spreads. When I say global, I mean over 20 years, we are at a minimum on both real interest rates, risk-free rate, and credit spreads risk premium. So the ability of liquidity to inflate valuations from here is very limited. Now, if you were to see significant downside, I think the Fed will step right in and basically limit the downside through financial conditions tightening by adding more liquidity. But between now and the next 12 months, I don't think we will see valuation-driven gains. We will see a much slower market of earnings-driven gains. And typically, the gains in the market in that sort of a situation are 75 to 80% slower than in a valuations-driven market.
So, Bhanu, from an S&P perspective, it seemed like a lot of investors were adequately hedged, so they can take this kind of sell-off. It feels like where the risk is with negative earnings revisions, and whether or not you're looking at, tough comps, you're looking at rising wages, you're looking at labor costs, you're looking at energy inputs, you're looking at a whole host of things. That seems to be the nut. When do you think we might start seeing that?
So that's a crucial question, right? Now, if you look at the last 20 years, how long has it taken for us to go from peak earnings momentum to zero earnings momentum? And the answer is somewhere between 4 to 6 months. Peak earnings momentum was seen in May, and that suggests that around November, you could be moving towards earnings momentum that's close to zero if it were an ordinary cycle. Now, given that this is not an ordinary cycle, and you're coming from a much higher level of growth, PMIs, earnings momentum, this could last till the middle of Q1. That's the time I think we really need to worry about, because you could be seeing both real interest rates moving up and earnings momentum coming down. So I think that's the time, November onwards, late Q1, that's going to be a challenging time for the market.